Running a business means keeping your eye on everything. Operations, clients, growth, administrative minutiae. I know. But too many business owners don't see the tax strategies right in front of them, the low-hanging fruit. Today, we're going deep into 4 powerful tax tools that business owners often overlook. Tools that can reduce taxes, shift income in a way that is compliant, and strengthen your business and personal wealth strategy. I'm not talking about gimmicks. I'm talking about solid tax law you can use that won't set off alarm bells, assuming you don't abuse them. And before I forget, go ahead and subscribe now if you want to see more content like this. Yes, now. Thank you. Let's get started. First up is the strategy that is often called the Augusta Rule. Here's how to master it. If you rent your personal residence to your own business for up to 14 days per year, you may exclude that rental income from your individual tax return, which means it is tax-free, while your business deducts the rental payment as a business expense. That's a dual benefit if you're counting. The business reduces taxable income, and you get income without tax on your individual tax return. And here's how you use it. Your business holds a legitimate event, for example, a planning retreat, a team meeting, client entertainment, at your home or one of your residences if you have more than one, and you charge fair market value for the rent. You document the event. For example, agenda, attendees, minutes, whatever documentation, whatever form that documentation needs to take. The home is legally yours, primary, secondary, or vacation home. And that's it. Those are the 3 rules. Here are some key rules to remain compliant. There's a 14-day cap. If you exceed it, you will lose the exclusion. The property must be your residence, not purely a rental property. The rent must reflect fair market value, and the business purpose must be real, not contrived. Why business owners use it? It turns your home into a tax-efficient asset, shifts income out of the business, and strengthens your personal wealth without extra tax. If you own your home and run a business, you should ask yourself, could my business rent all or part of my home this year? If the answer is yes, you might be looking at significant tax savings. Next up, reimbursements. Boring, I know, but when structured right, they become a silent tax power tool, like a drill, which can be used for boring. Anyway, enter the accountable plan. An accountable plan is a reimbursement system under which a business pays back employees or owners for business expenses without the payments being treated as taxable income. To qualify, 3 strict IRS rules must be met. Rule number 1 is business connection. The expenses must be incurred while performing services for the business and eligible as a business deduction. For example, travel, training, home office mixed use. You get the idea. Rule number 2 is substantiation. The employee must provide records of the amount, date, place, business purpose, and receipts for the expense. These must be submitted within a reasonable period. Typically, 60 days is good enough. And rule number 3, return of excess funds. If an advance or allowance was given, any unused amount must be returned within a reasonable period, and the rule of thumb for that is 120 days. If any one of these fails, the payments become a non-accountable plan, i.e., they must be treated as taxable wages and taxed accordingly. Why this matters? When reimbursements are properly handled, the business gets its deduction and the individual doesn't pay tax on the reimbursement. When they aren't, surprise taxes hit. So ask yourself, do I have an expense reimbursement policy? Are receipts timely? Are excess funds being returned? If not, you may be missing out, or worse, setting yourself up for extra tax. All right, the third tool that we're going to talk about is the QBI deduction, or the Qualified Business Income Deduction for pass-through owners. This deduction has been available since 2017, the passage of the Tax Cuts and Jobs Act. It was temporary until the passage of the One Big Beautiful Bill Act made it permanent. The QBI deduction under Internal Revenue Code Section 199A allows owners of pass-through entities, i.e. sole proprietorships, partnerships, S corporations, to deduct up to 20% of qualified business income from a qualified trade or business, assuming they meet the requirements. And as I mentioned, the deduction is now permanent. It had been scheduled to expire at the end of 2025. The deduction rate remains at 20% for now, although there were some proposals that had aimed at 23%. We'll see if they continue pushing for that. But more importantly, the phase-in limits for high-income filers increase from $50,000 to $75,000 for a single taxpayer, and then from $100,000 to $150,000 for married filing jointly. And these are for certain service businesses. If you own a business structured as a pass-through, this deduction can cut your tax bill significantly, especially when combined with proper entity structure, wages, and asset base. Some planning points to watch. Your taxable income must remain favorable. If normal income is too high, limitations may apply. Your business must be a qualified trade or business. There are specified service trades or businesses. There's a list of them that phase-out hurdles. So the certain businesses won't qualify for the full deduction, in other words. The deduction may also be limited based on W-2 wages paid by your business and the adjusted basis of qualified property. That last bit sounds like gobbledygook because it is straight out of the IRS instruction. But your tax preparer should know how to do the calculation to see if you qualify for the deduction. If they don't, find another tax preparer. The bottom line is this: if you run an S corp, partnership, or consulting practice, you should ask yourself, are we maximizing our QBI deduction? With recent law changes, now is the time to revisit your entity, your compensation, and your wages. All right, fourth and finally, the way you pay yourself matters as much as what your business earns. Let's talk about some smart pay strategies. For many business owners, the biggest tax opportunity isn't about getting more income. It's how they receive it. Think of your pay in three components. Number one would be your base salary or your W-2 wages. Number two, owner distributions or profit shares. And number three, fringe benefits and other tax-efficient perks. If your business is taxed as an S corporation, paying yourself a reasonable salary is key. The business saves on payroll taxes when profit distributions exceed salary, but the salary must still pass IRS reasonableness tests. Timing. Once your business profit hits a threshold, for many it's around 50 to 75K net, moving from a sole proprietorship to an S corp might begin to make sense. Each situation differs. Sometimes it's higher than that. Also, don't overlook the tax-free or tax-efficient perks your business can provide, such as health insurance paid for by the business, HSA contributions, your health savings account contributions, accountable plan reimbursements, which we talked about earlier, and then retirement plan contributions, such as a solo 401k or profit sharing plan. Why business owners use this strategy? Optimizing the mix between salary and profit distributions can reduce both income tax and self-employment tax, legally and compliantly, if that is a word. We're going to go with it. Ask yourself, is my business structured so that I'm paying myself the most tax-efficient way? If you're unsure, let's run the comparison now. All right, these four strategies, the home rental, Augusta Rule, an accountable plan for reimbursements, the QBI deduction for pass-through business owners, and smart pay and compensation structuring aren't exotic. That's why we call them low-hanging fruit. They're fully legal, fully legitimate, and often underused by business owners who are just too busy running the business to optimize their tax strategy. Well, here's your step-by-step next moves. Go ahead and just pick one and run the numbers. See what that looks like for you. Schedule a review with your tax advisor, or me if you like, to map out how this fits your business and income and how you might end up saving money in the long run. Also the short run. Why not both? Take action before year end. December 31st is coming up. Many of these strategies must be in place before the end of the year in order to capture full value. If you'd like help, I offer a tax strategy review for business owners where we dig in on all four of these and more, and we tailor them to your situation. Click the link in the description and let's work together to keep more of your hard-earned money in your pocket. Thanks for watching. Like, share, and subscribe. Leave a comment if you have questions or feedback, and I'll see you in the next video.